Today in the house, we have some stock picking enthusiasts. Although they started as an enthusiast, today they run probably one of the largest stock picking academy and one of the most popular stock picking websites in Singapore. They are going to share with us why they got into this space and how do they see stocks, debunking some of the generational myth like the stock market is a casino, and they are actually fundamental investors. So they see buying stock as buying a part of a business. So we're going to spend time today with Mr. Victor Cheng and Mr. Adam Wong from The Fifth Person to evaluate some business and of course have them share with us some of their experiences, some of the mistakes they've made, and actually Victor believes that everyone should learn how to pick stocks. So this is going to be a fun discussion today. Stay all the way to the end. It is jam-packed. Hey guys, I'm sure you've heard people tell you you gotta build a diversified portfolio. But honestly, how can we expect everyone to build their own portfolio? How about try Stashaway, one of the leading robo-advisor in Singapore and Malaysia. Their algorithm helps us to optimize our portfolio periodically, a simple way to start while we learn. Check out thefinancialcoconut.com/stashaway to get 50% off your fees for the first 6 months and stay invested while you learn what works better for you. Link is in the description below. Good morning, everyone, and welcome you to another day with the Financial Coconut. In our podcast, we'll be debunking financial myths, discovering best financial practices, discussing financial strategies that fits our unique life. You get it, ultimately empowering us to create a life we love while managing our finances well. And today in the house, we have the guys from The Fifth Person, Mr. Victor Cheng and Mr. Adam Wong.
Hi, everyone.
Hi. Thank you for having us. We're happy to be on the show, and just to share what we have with your listeners and what insights we have and all that.
Yeah, it's good stuff. And we've actually, like me and my team, we've actually looked at your website, right? And then we're like, wow, these guys must have some funding behind, because the website is so curated. It's very well done. When I look at it compared to other sites,
thank
right?
you.
So are you guys like bootstrappers or?
No.
Yeah, we're bootstrappers. So we've not taken on any kind of funding. It's entirely just
Just did it on your own.
we did it on our own and all that.
Damn.
I think the site is nice because of Adam.
Oh, you
because-
built it.
Well, I mean, I'm the editor behind the articles and all. I think design is one aspect of it, but I think the content that's on the site is something that is down to the writers that we have. It's not just the job of the editor, but I have really good writers. They share really good insights. It's not just about what you can buy or what you can sell, because we want to go beneath the surface of what the rationale is when you make those sort of decisions, rather than just what's the hot tip, what's the hot stock of the month. There's a rationale behind investing. Why do you pick a certain stock? Why do you sell it at this time? And there's steps that go into that. So we want to educate readers along the way as they're finding out more about companies in the US, in Asia, and all that, so that they level up their own level of financial literacy, and not just rely on ideas or tips along the way. They have to figure this out, because it's all about their money.
Yeah, man. And do you think that is like one of the biggest pitfalls that people have? Following tips and just looking at the charts and just randomly buying because someone said so, my friend say this one good stock or my broker call me, that kind of stuff.
Yeah, I think a lot of people may start off that way. I don't think everyone does. Some may take a more measured approach. But yeah, we do hear stories of people just falling for scams. I think Victor has some stories to share as well. And because I think the news makes it out that way. Because you see, articles coming up or like TV spots on CNBC talking about this stock that just jumped 20% in a day, and it seems like a really exciting place to make a lot of money in the stock market, right? Especially when the news is good and all that. But that's not the way it works. You need a really sustainable long-term approach to how you want to manage your money and your investments and your portfolio. Because slow and steady wins the race when it comes to investing in the stock market. It's a volatile place, definitely. So
don't listen to Kramer.
It's
The five.
It's entertainment. It's entertainment. Maybe you might pick up certain nuggets of information that might be really useful. But at the end of the day, whoever it is, Kramer, Buffett, ourselves, someone else, you have to take all that into your own whatever system you're using for yourself, I mean, decide for yourself what works best for you, because we can't do that for you. You know yourself best, what your goals are, what your needs, and what your risk profile is, and all that. So you need to know that first before you just blindly follow anyone else, even if that guy is Warren Buffett, or some other guru.
I think the issue with this following, guru blindly, and it's because that, let's say for instance, Buffett bought into the airline business, or maybe Lee Ka-sing bought into this specific listed company. But to them, right, the airline business or these specific companies that Lee Ka-sing just bought, right, it's just only a small percentage of their portfolio. It may be billions, but it's just a small percentage of their portfolio. So if that investment didn't gone wrong, then it doesn't hurt their portfolio. But the thing about retail investors is that when they say that, this tycoon bought into this stock, so they basically most of their money inside, and when that things didn't turn out well, it really hurts their portfolio.
Yeah.
So that's why we always advocate that you don't follow people blindly. Even for us, I would say that we also do have mistakes along the way in our investing, and I can tell you it's not 100% that you will confirm make money in the stock market. The stock market is like a jungle. You really have to dig your way through, find the right path, right? And even though you're on the right path, you are the right system, but you will still lose some money along the way. And that's where I think your portfolio sizing is very, very important, and knowing the right method. It's not like when you want to drive a car, you have to go through a school, learn it, and you are able to drive the car on the road. You don't see people just without attending any driving school and just straight away go and drive a car, and there will be a lot of accident out there. So same for investing. You don't just go into investing without a license. Okay, you go and get yourself educated, and after that you just go into the stock market, and your method is not 100% foolproof. That you have to be confirmed. Right? You cannot be saying that if someone tells you that I never lost money in the stock market, then I think you probably have to run away.
That's like a red light, right? Ding, 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 ding.
Correct. Because even Warren Buffett also lose money in the stock market. We also lose money in the stock market. Everybody lose money in the stock market. It's just that how you size your position, right? So that you got more wins than losses, and that's how you make money in the stock market. Yeah.
Yeah, I mean, I think the high flux saga was a great one, where a lot of retail investors just kind of like bought into I think it was the preferential shares, right? 6% yield and everything, and then a lot of people was the bankers, I think they were selling it. Temasek invested in high flux, and it's like, if Temasek bought this, it must be a good company, and that wasn't even true, because Temasek was in the early stages of high flux's development. When they were already
out in 2006.
They were already way before
out in 2006.
So that was misleading on one hand, and on the other hand, it was like those retail investors just didn't do their own due diligence, and they just assumed that just because a big boy is backing this or was backing this, it should be fine, and it wasn't, because there was a lot of if you took a look at the cash flow of high flux at that point in time, it was obviously burning cash, right? So maybe more savvy investors would look at that and say, this is risky, 6% is not worth it for the amount of risk I'm going to take here. So I think that's one lesson that I think a lot of people had to stomach if they got caught in that.
And the thing about if Temasek also do wrong, that investment is only a small percentage of their portfolio. If you go and see how the strategy that Temasek has been investing, right, they don't concentrate on any stocks. They really spread out, and some stocks don't even account 1% of their total portfolio. So they really spread their risk out properly, and they lose. It seems like 500 million, like I said, but it's a small amount to them compared to their portfolio size.
Yeah,
so
about
that's
320 billion, right?
Yeah.
So 500 million is like less than 1%. It's like,
At the end of the day, it's a lot about perspectives. Right?
Yeah.
I do think for the retail people, when you hear words like 500 million, right, and then, because when you size it to your own life, it's like, wow, this is a lot. Right? But when you relative it to their total portfolio, then that is barely anything.
I think you always have to see investment in percentage instead of the absolute amount. Even when you invest, right, you have to invest the amount. Let's say I want to invest like 20,000. Okay, so 20,000 is how many percent of my portfolio, right? So that's the key thing that I feel, because a lot of people when they invest, they just based on the lump sum, the absolute amount, and eventually that amount didn't turn out well, they will feel the pain, and that was the moment where they lose that money and they say that, okay, the stock market is not for me.
Yeah,
right.
Yeah, I hear that a lot. I hear that a lot. Right. And it feels like a generational thing. Like
Yeah.
my parents were in the period where the stock market was a more vibrant place,
Yeah.
right? Because there's an increase in accessibility, right? So more and more people are in the game, and then they burn their money essentially, right?
Yeah.
Because of all the leverage trade and all the T-4, those kind of stuff, right? Then it became it became like a narrative in their head. The stock market is very risky, confirm lose money. And then it keeps pedaling downwards in the generation, right? So every day I hear this kind of things, right? And when I first started picking my own stocks, I feel this kind of like thing going on. Like, is it really, how does that work? And do you guys face a lot of these kind of stuff when you first started? Like all these kind of narratives that are peddled down by your parents or
I
by
think
society?
it's like what you say. It's a very common thing because of the generation. My dad lose a lot of money in the stock market. I mean, he buys based on tips. My dad, he runs his own business. They can generate cash flow. So someone told him to buy this certain company. He said the insider of this company told him to buy. So he bought a large sum amount, and after that the share price came crashing down. I mean, he lost about, I think, 300,000 to 400,000 on that, right? So I think to them is every time you talk to the older generation, they will tell you that, okay, in let's say our dialect, the Hokkien, they will say that 升股票, that means it's play the stock market. So that's the thing that they have in their mind. That means stock market is a place for you to play. Actually, stock market is not a place for you to play. It's a place for you to invest. And if you can do it in a sound way, right, you can come out of the stock market successfully. So but the thing about a lot of people is they treat the stock market like a playground, right? So that's what I think make us worry also. And if my father have the education of investing in stock market, probably he won't lose so much money in the past. And to my father, he said, I'm out of the stock market now. I'm not going to invest.
Was he really disappointed in you then?
No. Now he put all his money with me. Yeah.
Okay.
So I'm managing all
okay.
his money for his.
So that's a different benchmark already.
Yeah. So basically now he don't touch the stock market, but I touch it for him.
That's
Yeah.
good.
Yeah.
That's cool.
Yeah, I think it's kind of like you do see this like generational gap, because when you go to the AGMs in Singapore, you have your uncles and aunties, they're retirees, and you get the feeling that there's some of them ask really good questions, right, about the business, the operations, what plans moving forward. But you do get the run of the mill uncle asking about my dividend, how come my share price went down, stuff like that, and these are probably the generation that maybe they just weren't as savvy, and maybe because information wasn't easily available in the past, so you get people like that lah. But I think, like I said, now there's a lot more information now. The younger generation, they're more savvy. They go online, they look for information, they compare credit cards and stuff like that. They have, everything's online. So I think people are more educated about what the stock market is. It's not really no longer a place. It's not no longer a glorified casino, right? Some people treat it that way, right?
Yes.
So and they're more measured in their approach, and then you see the younger ones nowadays, when they go to a meeting, they really take the time to study the annual report or certain portions of it, and ask questions that they have doubts about, and they want to clear that up rather than say, why is my dividend falling, or stuff like that. So it's good to see, because I think that overall raises the standard of what we're building in Singapore. You get really good questions in the US AGMs. People that are really serious about the business. They reached a point where they're no longer just talking about business. They're talking about civil rights, human rights with regards to the business as well. And to me, that was like beyond. I mean, I wasn't as interested because maybe I'm still where I am today.
Still a capitalist.
Still a capitalist, But they were really focused on those issues in the US AGMs as well. And I was like, oh, maybe we still have a way to go when it comes to our business culture here.
And I think I get why they are very concerned about these kind of like go green or like civil stuff.
Yeah.
Because the consumer there are very inclined in such a direction, right? So then it will then affect a lot of purchasing habits, and it goes forward from there. But maybe like what you said, like consumers here are still like, oh, cheap and good lah, right? Then
I think we're in a sense we're still very pragmatic bunch.
Yes.
Yes. But over there, I think in the West, they care more for these social issues, and I've gone through a number of AGMs where they bring up all these social issues, and the directors of, like, say, Facebook or Google say, okay, we're against this resolution because of this and this. So basically, all the civil issues that they bring up is basically going to be downvoted. But they still care about bringing it up because they want to have a voice to these things. Even though they know it's not going to be passed, they want to bring it up. They want to have a voice. So I think that's something that we don't really have over here, where people are not so comfortable putting a voice for certain issues. Because over there, it's like, I just want to say it out, even if I know it's not going to get voted through. I want to make a point about it and let people know that I'm making a point about this. And that's it. Yeah.
Yeah, I totally get that, and maybe someday we'll be there, right?
Yeah.
Someday we'll be there. We never know. But on the point that you guys were saying about a lot of information these days, right? So now in the world of internet, then everybody with a microphone like us, we could just live and chat and talk. Do you think there is information overload? Right, there's just too much information out there that it becomes another problem, right? Of how do you then filter these information?
Yeah, that's why having a process and a system is so important when it comes to investing. You need to know what you're looking for, what type of stocks you're looking at, what fits your, like I said, your investment goals, what fits your risk profile, and then running through a system where you have your own criteria about whether this stock is suitable in the end for you. That's very important because you need that framework. Without that framework, you're going to get pulled all sorts of places, Because maybe, for example, if you are a dividend guy, you want to have passive income and all that, you want to build that for your retirement 30 years down the road, you should invest in a particular way, right? But if you don't have that framework for yourself and you don't understand what you actually want, then someone's going to say Netflix is a great stock. Yeah, Netflix could be a great stock, but it may not fit someone who wants to invest for dividends. So then, if you don't have a framework, you get pulled in a direction. You invest in Netflix, it goes up 100%. You're over the moon. The next day, it goes down 50% because it can be really volatile, right? And then you're going, what happened? And then you get scared, or you make all sorts of emotional decisions that could get your investments in deeper water and all that. So that's so important to have that system for yourself that gives you that direction before you actually start investing.
Nice. What about some of these mistakes that you guys have made, like along the way when you first started? Share some interesting stuff.
I think that it depends on your personal experience, but from my experience is that in my early years when I just started out, I'm very a number focused person. Okay, so there's a lot of companies, especially in Asia, right? Their numbers are very beautiful, but actually there's a lot of related party transaction in Asia, right? So especially if you want to invest in Asia, right, you have to really focus on the business and the management instead of the numbers. Because my understanding is that if the company have very good management, have very good business, right, the numbers are naturally very beautiful already. So because I remember got this Hong Kong company that when I was still managing the fund, I actually made the call to purchase it. So this company have very, very beautiful numbers, increasing revenue, increasing net profit, increasing dividend, and also the ROE also very high, very beautiful numbers, a shoe company. So we invested in it, but within 6 months, the company actually dropped about, I think, 40%, right? And why they dropped is because their cash position suddenly decreased by more than 40%, right? So if you really look into the business and the management of this company, right, you may not want to invest in this company, even though the number is very useful. Firstly, it's because they are in a very, very competitive space. Right, so I really invest them based on numbers. I didn't really go down to look at that until I think 2 years later, where I went to meet the management. I feel a bit not comfortable. This is the first thing. Second, I went to visit all their stores in China. So when the moment I stepped into the stores, right, you can see that, especially on the street where all their competitors are there. So when you step in, suddenly a lot of the Chinese sales staff will start running to you. Oh, 折扣, and just like trying to rush you to buy, and you go to every store, they are like that. So it's very, very competitive in this business. If I've been on the ground and if I've seen the management, I probably wouldn't have invested, even though this company have very, very beautiful numbers, right? So that's the thing about investing in Asian markets. Is quite a messy jungle, but you have to really path your way through.
Yeah, I think the business is the most important aspect of investing, because that's what you're investing in anyway, businesses, right? But a lot of people kind of forget that, and they invest in they're investing in this stock symbol,
The ticker, right?
The ticker symbol
Yeah.
that could go up 10% today and then 20% tomorrow. And then they might go a step further and say, oh, you know what? I'm actually not just looking at the ticker symbol. I'm actually looking at the profit and the revenue. You know, like Victor was saying, all the numbers. But numbers are just a means to an end. They tell you a particular story of how this company is performing. But why do they perform this way? What made the revenue go up this year and the next? Why did it go down the next? You know, why is profit doing so well? Why do they have so much debt? So the numbers will leave clues for you to go and find out what's happening the last 5-10 years. And you need to go find out what's happening. What's the story behind this company, so that you know what you're getting into. It's kind of like dating somebody. You need to understand what's with this person, what's with their history, what their habits, what their likes, what they tend to do. Same thing with a stock. In some ways, okay. I'm not saying like stock and people are the same, but yeah, the business really important. So my biggest mistake was actually during the financial crisis in 2008. I thought I was doing value investing by investing in Citigroup, right? And at one point at its peak, it was at $60 per share, and I went in at $30 per share, so it was like 50% down from its peak. And you got to remember, during the financial crisis, the overall market crashed by 56%. So if Citigroup went down by 50%, you think it's like maybe it's at the bottom or something like that. So you know what? I thought this is a business, is not gonna go bankrupt. You still see Citibanks everywhere, right? It's one of the biggest banks in the world. So they're gonna be around after the crisis, and it's true, they're still around after the crisis. But I really didn't understand the business. I really didn't understand the assets on its books, all the toxic assets that they had. They had to just write away, one fell swoop. And basically, you look at the share price now; it's never recovered to its peak in 2008. So that was an expensive mistake for me. And I realized that a little bit of information, no information is bad, but a little bit of information can be really dangerous as well, because you think you're doing something well, but then actually you have a lot of gaps, and then you kind of like screw things up, like I did, and then you realize, I need to know so much more before I actually invest. So I realized that I need to actually like go level up my skills and really figure out how this thing works, and then you start investing.
Yeah, sounds like the SIA of today, right? The Citigroup 08 is the SIA of today.
Oh well, the airlines have always been so competitive.
The airlines are
very cutthroat.
I think the airlines are very bad business.
Yeah.
Firstly is your consumer that comes to you, they always they always goes to the cheapest air ticket, right? So this is first thing. It's very competitive already. Second is, if you are in a very competitive space, right? Your competitor must die. But the thing about airline business is your competitor never die. Every time when they go bankrupt, right, somebody will go and bail them out. You look at Malaysia Airlines, they die so many times. Japan Airlines also die a lot of time, but still come back. So basically you're driving a Ferrari in a very bad traffic jam, and no matter how you drive, right, there's always car blocking you, right? So that's what happened in the airline industry. And on top of that, they have to, every year when they generate the profit, they have to consistently spend on the capex to refurbish or buy a new planes, and this really eat up to their cash flow, free cash flow, So I think generally airline business is very tough, and I don't really want to be in it. And when Buffett bought into it, I was like quite shocked, why did he bought into airline business? But to be honest, the US airline business are generally much more profitable, because I think they fly within their states, and there's less tax and costs, and that's why they are profitable. But compared to the Asian airlines, because they go through different countries, and that's where it makes it more higher cost, and also the fuel that can affect them. But then I still don't really like the airline business.
Yeah, I think Buffett invested in the US airlines. He invested in 3 of them, right?
Yeah.
All 4 of them.
All 4, I think.
Yeah.
Okay. Mainly because there was basically a oligarchy. Oligopoly, actually. Not oligarchy. Oligopoly.
It's kind of like an oligarchy in that sense.
Oligopoly within the domestic US market. So he wanted to, basically buy up all 4. And in that sense, he made, pre-COVID, that made a lot of sense, because he likes to invest in industries where, but a handful of companies have, taken a really dominant position, and there's really nowhere else you can go. So if he invested in all 4 of them, it was kind of like that, because it's an oligopoly in a sense. But then, of course, the pandemic came and changed the entire picture. So he got out of it, and credit to the guy because he realized that he made a mistake. I mean, of course, now you can say he prices have gone up again, right? So he didn't, he shouldn't have sold so early or something like that. But then he's basing it on a business decision.
Yeah.
Right. So I mean, credit to the guy. So he made a mistake according to his investment thesis, and then boom, you get out, and then you redeploy your capital somewhere else.
Now let us take a break. We hope you're enjoying yourself so far because we definitely are. And we will be back with you after a word from our sponsor. So this is the last week of the Fifth Person's Investment Quadrant program sales period. They only sell it once a year for about a month. And for all of you who have signed up, cool stuff for you. And for all of you who are still considering to sign up, our team at TFC would like to throw in something additional. We are stock picking enthusiasts ourselves, and we hope to be part of your journey, engaging in thesis discussion so that you have a stronger thesis about the stock you're eyeing on and share with you our experiences along the way. So we will be creating a Facebook discussion group dedicated to stock discussions after your course. To be on this journey with you, head over to thefinancialcoconut.com/value to learn more about value growth investing. You know, when I look at it, I think I agree with you guys. Like, there's too many people following all these gurus, right? Essentially, it's blind following, or like blindly following insider information or tips or gurus, all this kind of stuff. But there's also another bunch of people that I think needs to be addressed, which are those that like are just trying too hard to numberify everything, right? To make it feel like it is manageable, right? Like everything is predictable, right? It feels like people are not willing to accept that in the market or in business, there will definitely be uncertainty. There's definitely some level of art, right? It's not all science, right? And what do you say to these kind of people? Because when I look at it, it's like if there's too many caveats in this model that they built to try to understand this company, but then there's like, we assume this, assume that. So when there's too many assumptions, then this thing is as good as bad, right?
I mean, a model can only be as accurate as the amount of elements you put into it to try and capture the real world as much as possible. But the real world, the business world, the stock market is an infinite game. You have new things coming in from anywhere else. You don't know what's going to happen. Like almost no one could predict that COVID-19 was going to happen, except for Bill Gates 5 years ago, right? But no one knew. So that's the thing when it comes to investing. You're not investing in, you're not playing a game with numbers and all that sort of thing. You're investing in the real world, in real world businesses, with real world operations that affect real people out there. So you got to take that into account. And things can just happen in the business world. It just changes paradigms, changes things completely. Same thing when you invest in the stock market. It's not just the stock price is a function of people's emotions, right? Sentiment and all that. If you can't predict the mood of your wife tomorrow, how are you going to predict, the mood of like millions of people everywhere around the world when it comes to investing?
And the assumption is you can't, right?
You can't. Right, you can't, right? I can't predict my mood tomorrow and myself, right? I probably think I'm going to be fine, but maybe I step on a piece of doo-doo and like, what the hell, right? I get a bad day, for the rest of the time. But you see, that's the thing. You can't predict human emotions in the short term. Day to day, you don't know how you're going to feel. Overall, a certain person has a certain disposition. They're generally happy, but everyone's going to have bad days along the way. So it's kind of like the stock market. People say the stock market is going to grow up over the long term. In general, okay, yeah, but then day to day, you don't know. So you got to take that into account. Make sure you understand what level of risk you're comfortable with, and then you, like Victor was saying, put position size so that you don't expose yourself too much in one particular position. If not, if that goes wrong, then you got to restart all over again. That's going to be really, really, really painful.
Yeah, it is.
Yeah.
Trust me. Yeah, we've all had some experiences.
Yeah.
But knowing what you guys know, right? Like, you're managing your own money, you're managing your family's money, and with all these kind of experiences and knowledge that you have, I'm just kind of curious, why are you in this whole course space, right? Building courses and being this training arena, right? Because how I look at it is there's just a lot of noise, and there's a lot of, for like a better way to put it, a lot of fake gurus out there, right? So you're in this space that is quite noisy, right? Okay. So I was just kind of curious, why are you guys still willing to do it and take this path of building programs?
I think the thing is that we didn't really actually comes to this actually. We like I told you, we actually thought of just sharing free stuff online, and after sharing for quite some time, people start asking us for courses, and we just build it from there. I'm not saying that all these gurus are bad. There's of course some very genuine people out there, and it's just that we just do what we think is right, keeping the cost fee low so that everybody have a chance to really learn investing. But of course we also have our things to feed on our side. I mean, we have staff, we have employee to feed, we have rental to pay, so we cannot really totally give 100% free, okay, but we think what is reasonable that we want to give out, so that's why we keep the cost fee low. And I know there's a lot of negativity over all this, so that's why our approach is never always to to talk about returns or what. Is my approach is always to share about what we know, right? And we never force sell people anything. We just tell you this is the thing that we have, you want, you take it, right? We don't tell you you can rush your table to over there and go and sign up by now. If you don't sign up now, okay, you're going to get out away the discount. You cannot get out of this room. You have to sign up the course and all this. We don't do that. I think it's naturally wrong. We usually let people decide. And to be honest, if sometimes I feel that the person is not ready, I usually will tell them that I think you should get your finance fixed first before you even come and learn about investing. Because a lot of people they treat the stock market like Adam says, like a casino, and they keep thinking about the gain. But you should not go into the stock market thinking about the gain. You should go to the stock market thinking, how do you reduce your losses, right? You come from a inverted way of thinking. You want to protect your downside, not always looking at your upside. If I keep protecting my downside, right, and I go in every company in a very high probability way, so that means I know that, okay, I invest in this company right now, it fits all the criteria, it's very high probability, my risk is very low, right? You may miss out, okay, you may lose on some, but overall your probability will hit eventually. So that's the way you should go into the stock market. Instead of going to the stock market, looking at, like it's very a place that I want to gain money. Right, so that's what happened to certain people. Like I said, their personal finance is not strong, and they want to go in the stock market. They have debts, they got housing loan, they got credit card bills to pay, or credit card debt that they balloon up. And my take is that these people should not even invest. They should get their finance right first, because if your finance is not right, you got no right to invest in the stock market. Right, it's because it's going to be very dangerous. Because every time you start investing any of your money in the stock, you will every day, right, you'll glue your eye, right, to the stock price. Because that's the only money that you have.
Yes.
Right, you cannot do that. Right. So
stressful.
when you invest in stock market, right, the money you invest, right, is the money that you do not need for the next 10 to 20 years. Right, it's excess money, and you can afford to lose one. Right, so then you will do well in the stock market. But if you invest your children education, your house, the money to buy a new house, then you won't invest in a very, very safe way. You will invest in trying to make more money out of that, and every time if that investment goes down 50%, like I said, you will glue to the stock price again. It's a cycle.
Yeah.
Right.
Yeah, I think when it comes to investing, it's kind of like we were saying just now, just like driving a car. To learn how to drive a car, you need to learn how to work the gas, the pedals, the brakes, turn on the engine, the steer, everything. But knowing how to use a car is very different from knowing how to drive a car. Because if you know how to use a car, yeah, you can step on the pedal and you can go straight, you can turn left and right. But if you don't have your mindset put on right, and you're a risky driver, you're going to get into an accident. So same thing when it comes to investing. Doesn't mean that you know how to read a financial statement, you know what the ratios are. Doesn't mean you know how to invest. You just know how to read those statements. But the psychology that comes behind being a long-term successful investor is really knowing how to drive a car safely to get you from point A to B, right? So if you're a safe driver, you look out for other commuters, you look out for the traffic lights, you understand the conditions around the road, so you don't take unnecessary risks, you don't get into accidents and all that. Same thing when it comes to investing. You got to understand the situation around you, what kind of businesses do you want to get into and all that, and then you drive that way, you invest that way. So a lot of times skills and the psychology are two different things. And people get caught up in the skills and all that, and then they apply those skills in a way that's very risky. Like Victor was saying that, oh, I want to like double my money in the next year or so. You know, I want to invest in this company. It seems like it's going to be the next big thing. And then by then you forget about protecting your downside. You know, and if you just one wrong move, bam, you hit you really hard. You get into an accident. You know, like a real life car accident, and that's
true.
Not, yeah, you don't want to get into that. Yeah.
Yes. I think a lot of people don't realize that whenever you lose 50%, you got to make 100% back.
Yeah, and that's a great stat. And another one I ask is like, if you lose 70%, how much do you need to make back?
Wait, is that 300%?
Yeah, about 277%, right?
Yeah, about 3 times.
So that's crazy.
Yes.
You know, you think it's I just got to make 70% back. No,
No.
bro. You're gonna make almost 3 times your money back just to
Yes.
get back to where you were. So
Yeah.
Buffett's like famous quote about don't forget rule 1 and 2 is very pertinent. Yeah, you got to know.
Sometimes Warren Buffett's quote may be very simple, but probably it takes you like 10 years or 20 years to understand what you're trying to say. I mean, like I think he got this famous quote is far better to invest in a wonderful company at fair price than a fair company at a wonderful price. Okay, this is very simple quote. Okay, and I think everybody read this quote, they really understand it. But to really apply the exact same method, right? It took me, I think, 10 years to understand, you know, that, okay, this code really works, you know. Because after so many years of investing, I realized those companies that I bought, the wonderful companies that I don't pay at a very cheap price, I pay at a fair price, turn out be the best companies that you know you can, it's better than those that you pay at a fair price and you buy at a margin of safety. So like I said, if you don't go through the experience, you will never understand this code. But if you go through the experience, you understand this code, and that's where your investing style change. But of course, you can learn your experience from somebody else. Or
I get it, man. Like, there's so much talk about margin of safety, right? Buying it cheap, you know, undervalued, But honestly, good companies rarely come cheap.
Yeah.
At least in my experience.
Yeah.
Right? It's like it's like I think Starbucks, right? I think I want to buy Starbucks for a long period of time, and I was like, well, this is very expensive. This thing, I'm waiting for you to come down, but it never comes down.
Yeah.
Right? And then the new CEO came in, the tech got rolled out, and then revenue flew, prices flew, and I'm like, oh, okay, 没有了咯.
And then when it came down, it was during COVID-19, and then you're like, shit, should I invest?
Yes.
Because like no
exactly.
wonder stores are all closed.
Yeah.
So it's tough, you know, because it will take a bit of confidence to invest right in the height of that pandemic when, you know, China and the China stores and the US stores were all closed.
Yeah.
But you know, the share price has gone up again.
Yeah, it's gone up again, right?
So investing takes some
guts.
Yeah.
Takes a bit of making a measured, you know, risks and, you know, making
But I think it's to have a proper system.
Yeah, proper system.
Like we have a proper system. I mean, we have a proper system where we have the companies, you know, the valuations on this Excel. You know? So when the price change, it can reflect. So we just purchase the company based on the, like, hit this price we buy, hit this price we buy, you know. So we take our emotion out. We just focus on the system, and it turned out well. I mean, you have to really take your emotion out of investing. If you are a very emotional person, right, that anything can. If you invest, if the stock price move up, move down, it can affect your mood. My take is don't invest in the stock market.
Yeah.
Right, it's very, very hard.
Your spouse is gonna have a hard time.
Yeah,
I'm sure that's all person. It's like, it's kind of like those hardcore football fans. All right, my team won. Oh, yeah, and then my team lost. What the hell? You know? Yeah, people like that.
Yeah. I'm not a hardcore football fan, but I've met those kind of people.
Oh, really?
Right? It's like after a good day, it's like, why are you so happy today? Because Liverpool won now. Right? It's like, why are you so sad? Oh, because we lost. I was like, bro, you're not even there.
Yeah, you're not from Liverpool.
It's like, it's not Tampines Rovers, you know?
These Rovers.
So yeah, I get what you're saying, and it sounds like you guys have done so much over the course of so many years, right?
Yeah.
At what point in time did you recognize that, okay, this thing is legit and I can actually make a living out of investing, right? That made you decide to, okay, we focus on this. Right? At what point, you know, do you realize, okay, maybe this can really be something?
I don't think there's any particular point. I think that we always feel that there's so much more to learn, even at this point right now when we're managing maybe like a 7-figure portfolio and all that, you know, it's like there's still so much more to learn. There's so much more that we can improve, and the thing is, like, you don't know what you don't know, right? So there's things that you didn't realize about the way you analyze a certain stock or stuff like that. They say, oh yeah, I didn't know about that. Was there a particular point?
I don't think so. I mean,
Yeah, we're just always
Yeah.
improving. Just like
Yeah,
you
but-
grow. You grow from small. You grow a bit bigger. You make losses along the way. You have wins along the way, and then say, "Oh, I didn't know about this." Sometimes some of your winning stocks is like, "Oh, I." It's not always your mistakes. Your losing stocks give you the insights. Sometimes the winning stocks give you insights as well, and we just improve along the way. Yeah.
for me, I think it's more of a passion. I think I can really eat, sleep, and drink investing, right? So I cannot imagine not doing investing. So that's the thing for me. And other than doing investing, I really don't know what I want to do, because I've been to many jobs. I was previously not in the finance industry. I was working sales in a polymer industry, plastic industry. And I was so bored. I don't.
Sounds boring.
Yeah, it's very boring. It's really very boring. And the thing is, I spend my free time at work reading annual report. So then I know that, okay, maybe investing is really what I want to do. So then that's how after that I just keep focusing on investing, and it did turn out well. I think if you follow your passion, and your passion do pays you well, then it worth spending your full time on the passion itself. Yeah.
I think if you ask me, if like you, for a general sense, how do you know when it's working for you, right? I think I would say that, let's say I would give myself a minimum of, let's say, 5 years, and during these 5 years when I've been investing, and you've been investing in a way that you've been really disciplined, and you've been sticking to your system, and you've been investing based on these principles, and you've been doing it consistently for the last 5 years, and over this period you see that my portfolio has really grown. I've not been investing and making it because I was lucky, because I was taking a punt, I was speculating. If you invest it that way, you don't really know if you're actually going to be successful over the long term. But if you're investing in a way that's very, systematic, you're prudent, you take conservative risks, and you make decisions that way, and then you see your portfolio bearing results in that sort of way. I think after 5 years, you will probably think, yeah, I think I got this down, because you've been sticking to that for 5 years. You can probably stick to that for like another 5 years, and you know what you're doing. You're not taking mindless bets. So I think minimum of 5 years is a good enough to tell whether you're doing it right in a way. Yeah. So I would give that sort of a general guideline. Yeah.
Cool. So I think at this point in time, the playing field looks like it's changing, right? Interest rates are going to stay really low, and there'll be a lot of money flowing in, and looks like there's some sort of dissonance between financial market and the real economy, right? And that may go for another few years. But does it change your way of investing? Do you reference, because there's a lot of way to invest, right? Some people are more macro trends. You guys are you pick your own stocks, so you're not really interested in like how the indexes move, right? But does that actually, like this kind of macro changes, is it going to affect how you're going to decide on the companies you pick?
I think it will not affect us, because we are actually a very bottom-up approach investor. So we just primarily on the company itself, the business, their mode, their management, and how long is their runway. I mean, as long as the runway is continue to be there, we will continue to be invested in this company. All right. I don't want to. I mean, another mistake that I also learned throughout the years is because there was this one company in Malaysia called Hartalega. It's a glove company. We bought. We bought a small stake. The company doubled up, and we invest a bigger stake when it doubled up. And after that, the stock I think went up about 70%, right? So and at that point of time, this company growth was like I think 20% expected growth, but their PE was traded like 30 over time. So I was thinking that maybe this company is a bit more expensive, right? So we sold it. But since then, the company, from the purchase price we sold, right, it went up about 5 to 6 times from the price we sold. And of course, the recent COVID, it went up even further. Probably we will hit 8 times or 9 times returns, right, from this investment. So this one thing I learned is that if you come from a bottom-up approach, you invest in a good company, you don't care what's the sound in the market. As long as the company is doing well, the runway is still very long, right? The management is still intact, it's still good. Just stay invested all the way. Doesn't mean it's expensive, you should sell. Sometimes expensive company can become more expensive, right? And that's what happened to Hartalega right now.
Yeah, I think that's an example of a winner. We made money in that stock, right?
Yeah.
but we learned something.
Yeah.
You know, we said, oh, we should have held on to that company even longer. It's a great company. So in general, we don't look at economic cycles and use that to try to predict where the market's going to go. I think no one can do that accurately 100% all the time. You know, so economic cycles are part and parcel of like a capitalistic system, right? You have your booms and your busts. And we still do the bottoms up approach. But if you're asking me if we do look at a macro level, we do look at it from, let's say, you kind of understand where the structural changes are going to happen, where the trends are going to go. You can tell that e-commerce is going to grow even bigger from where it is right now. You can see that, you know, the cloud industry and, you know, moving everything online, the data centers, all that, that's going to be a growth industry. So you can kind of see these structural changes yourself as a consumer, and this is the direction where the world is going, and then you can look for ideas within those areas, and then of course you still use the bottoms up approach to pick the best companies within those areas. So like Hartalega was in gloves, right?
Glove industry.
So that industry on its whole was a growing industry. Yeah. So we just can't predict, you know, whether it's going to be a COVID or a financial crisis or it's going to be economic bust or whatever. But, you know, as a whole, you can see where the trends are going.
I remember we bought Hartalega at around 14 times PE. Now it's like 90 over time, you know. You can imagine, and the business profit have grown. So you can imagine how much we have lost after we sold Hartalega.
I had the same thing with Netflix. I invested, I made about...
I was about to say
asking about
Netflix,
Netflix, right? Yeah. So again, that's a great industry where people are cutting the cords and they're moving to OTT entertainment and all. So Netflix is right smack in the industry. And it's a structural change. You see people just not subscribing to cable anymore, and they're going to go to Disney Plus and all this stuff. So I made about 200% returns on Netflix. It was a great investment, right? But if I held on longer, I made even more because Netflix has really, really gone up. And I sold for the same reason. I thought Netflix was just too expensive. The PE was really high. I didn't like the amount of debt that they had, and they still have and all that. So, and they were burning a lot of cash. So it was just, it didn't fit my risk profile if I wanted to justify it to myself, right? But yeah, that was one example of a company that if I held on longer, I could have made a lot more money. Yeah. But you know, sometimes you got to just pick and choose the type of companies that you're comfortable with. I wasn't comfortable with Netflix at that point in time. But they're right in the middle of a great industry that's going to grow in the next 5-10 years.
Yeah, it's going to continue to grow.
It's going to continue,
Yeah. It's going to be interesting. And on the cloud, right? Actually, what you're talking about, like, actually is already showing in a lot of the rental spaces, right? So in the cloud rental space, all the racks, the rental prices are going up. So a lot of these guys are recognizing, a lot of the data center providers, right? A lot of hardware providers, they are recognizing, you know, the increased demand. So it's getting reflected in a lot of these, how much they rent, right?
Yeah.
So it's probably going to reflect in.
It's gonna be accelerated because of COVID, right? Because now we have video conferencing and all that.
Yeah, man.
So, and then you realize that if you're going to go into cloud, then cybersecurity becomes very, very important because if you have all your data online, it needs to be secure. So then you go into that sub-industry as well, you know, or maybe a sister industry where cybersecurity is something you want to look at as well.
Yeah.
So there's a lot of people who choose cloud providers. They want someone who's reputable. They make sure they have systems that can really protect their data. So Google is in this area. Amazon is a pioneer. Microsoft is in this area as well. So all these big companies, you know, really growing in this cloud area, and you know, there's another area you can go, you know, find your investment ideas.
It's an interesting, very interesting space, right? All the way from the semicons, the hardwares, all the way to the space, to the softwares, everything. Yeah. But it's a complex.
It's
very
complex. You really need to
space.
take your time to understand it.
It's not like buying Starbucks, right? You
correct.
don't have real interaction day to day.
Correct.
Right. Yeah. So these are some of the sectors that you really gotta work hard to understand.
I think it's a good point that you brought it up because you know, even though it's a growing industry, doesn't mean you got to jump in. Yeah, you need to understand what you're jumping into as well. Because it's not. Everyone can say cloud is going to grow, but how do you know that the particular company is going to remain, you know, competitive 5 years down the road? Yes. And you need some, you know, expertise in the area to decide and, you know, tell whether that's going to happen.
Yes. Like Apple just announced that they're going to build their own chips. Right?
Right?
So they're gonna directly get
They're gonna cut Intel
Yeah,
off,
they're gonna cut
Yeah.
Intel off. They're gonna cut AMD off, and that will change the game also, right, in the chip space, which is very intertwined in the whole, cloud space, today, right? So think of it how you would think, I would be very interested to hear from you guys. When do you sell? Right, because everybody talks about buy, what price to buy, blah blah blah, but nobody tells me about. So when do I sell? Right, under what situation will you sell?
I think we only sell when we make a mistake in the company. I think we don't sell a winner. That's one thing I learned throughout this 10 years of investing. You don't sell your winner. You keep holding your winner. As long as your winner is still in the long run race, you don't sell it. Okay, but you sell your loser. Okay, because your loser, there's high probability will continue to be a loser the next 10 years, right? But it may be painful, but imagine if you lost 50% in this company and you take the whatever you lost and you invest in another winner that give you maybe another 2 times, 3 times, you already make back your money, right? But if you continue hold on to the loser, right, 10 years down the road, you'll still be a loser, right? So the first thing is you judge the company wrongly. Right, so maybe you thought the business would turn out this way, but actually the business is a very tough business, right? You sell off the company, and I think probably another time when you really have to sell is because somebody want to buy out your company.
Yeah, you got no choice then.
You have no choice, you have to sell already.
You gotta sell.
Right.
Yeah.
Right. So the key is always, if you realize that the initial thesis that you choose to invest in this company have already shifted, right? Then I think you have to really sell the company, okay? Because every time I come in the point of view is right. In the initial years, I always want to invest in the company, and I want to thought of make money. But as the years goes by, right, I thought of like investing in the company based on how good the business is and how my risk is reduced. And the next thing that I really learned in this current era is that when every time I want to invest in this company, I ask myself, can I hold this company for 20 years? If I can hold this company for 20 years, right, if you got this mindset, right, then every company that you analyze, right, you'll be very, very tight, right? Then the mistake you make will be lesser, okay? So there's a thesis on why you want to invest in this company. And that's why every time I advocate that people should write down the thesis, why you invest in this company. Because a lot of people, they just analyze, okay, like that, they buy. But they forgot their initial thesis. So if at this moment, you look at this company, it goes down 50%, it goes down 70%, you go back to your thesis again. Do I still invest in this company? Is this still the why that I invest in this company? If the why have changed, my suggestion is that you should clear off the company, regardless of the losses, and redeploy to something else, right? So that's how do I sell my company? Yeah.
Do we want to contextualize a bit? Like, I get it. I don't really like to pick a particular stock to talk about, because that kind of narrows the view. But I just want to talk about something that you recently sold, right? That you think it's a loser, and why do you think that is a loser?
Okay. So recently I sold because I don't think the company is a loser. It's just that I transferred to a better company because of there's much higher quality. Let me share, let's say, one company. Let's say this company in Singapore called OKP. It's a construction company. They build the highway. They do construction, maintenance, and you thought it's a good business. They got this certain amount of order books called got about 400 million. So this order books is confirmed revenue that they're going to get if they build. So along the way, I analyzed the company based on the order books that they have. Then someone went to investigate the company and realized that the order books is so-called, the way they recognize is very different from the normal industry recognize. Okay, so what happened is that the normal construction industry recognize the order book is that every time they complete the project, right, they remove the amount from that. But for OKP, the way they recognize is that, let's say I got a 400 million project and I completed 100 million, which is only 50% of the project. I still leave it in the order book until I complete 200 million, then I remove it.
Okay.
So for me, I already know that, oh shit, the order book is inflated.
Inaccurate.
Yeah, it's inaccurate. So I did wrongly. So regardless of the losses, I remember we lost about 20%. I think if you hold it until now, I think your losses is even more. Right. So that's my take on when you should sell when you make a mistake, right?
Cool.
Compared to your initial thesis of how you actually invest in this company. Right.
Yeah. Cool. Yeah. Essentially it's a little bit like a 1 foot in kind of thing, right?
Yeah.
You're already 1 foot in because of your initial thesis, but
Yeah.
as you go along, you realize that these are some things that
Yeah.
I never thought about.
Yeah.
Because
Yeah.
maybe this sector is very far
Yeah.
away from me. Like, who the hell knows how to
Yeah.
build highways, right? Like,
Yeah.
and you learn more, and then you decide, okay,
Yeah.
and it challenges the original idea.
Yeah.
So then let's go.
So that's
somewhere.
why, like I say, portfolio sizing is very important, right? Because every time you invest in one company, you can never be sure that this company will make money. Because along the way, you will learn something about the company, right? Nobody is 100% sure every time when they invest in the company. It's just that along the way, you'll learn. And if the company makes mistake and, it doesn't fit your initial criteria, then just cut it off. It's not painful because you size it at a certain position that you are willing to cut, right?
Yeah.
So do you guys feel like everybody should learn how to pick stocks?
Okay, I think everybody who have their finance handled properly should learn how to pick stock. Because if you are just working, and you're getting your day job your day job income, and you're not investing in property, you're not investing in stock, then over a long years, right, your money will lose its value, right? It don't make sense to continue to do nothing and just relying on your pay, because it just lose value over time. So if you are someone who already get your personal finance done, you buy the whatever insurance that you're supposed to buy, you cover your insurance, and you have your personal finance in case you lose your job, you still have your money down there, and you have excess cash, right? Only the excess cash can be used to invest in the stock market. Then you have the right. That's what I say. Yeah.
I think everyone should learn how to invest. Whether or not it's going to be the stock market or not, it's really up to the individual whether they like the stock market. But you look at it, there are not many asset classes in general. I mean, in Singapore, you have property, which is like you buy your first property, the second property, not many people are going to have the money to afford a second property because it's a big chunk of money, right? When it comes to bonds, sometimes the quantum for a single tranche is pretty high as
Actually,
well.
bonds are way more complicated.
Yeah.
There are a lot of people don't realize.
Yeah.
It's so complicated. It sounds simple, right? So it sounds
like
like
guarantee
guarantee 赚钱
returns,
one,
yeah.
right? No, but no, man. The tranches are so complex the way they
Yeah.
build it.
And when you analyze the bonds, right, you also have to go analyze the company.
Yes.
So
Same
you
thing.
spend the
Yes.
same amount of
Yes.
of effort. Why
But
don't you
kept
invest
your,
in? Yeah.
Yes. You
Yeah.
kept your upside.
Yeah.
Right? You spend same effort, you kept your upside, and then
Yeah.
actually they're built in tranches, like what
Yeah.
you said, which is so complex for an individual to,
Yeah, and
to
sometimes
get it.
I think the minimum tranche is maybe a quarter million. Something is out of reach for the
Yeah.
regular person. And then you have gold, which is not really an investment. It's more of a hedging instrument.
Yes.
And then you have stocks, right? And then the rest are derivatives in a sense, like futures, options. Those are not investments. So I think everyone should invest, but so where should you invest? So you have all these different places. Yeah, you maybe have your property. You can choose to treat your CPF as a bond, at 4% a year and all that. And then if not, then you got excess cash. Where do you put it? So a lot of times, the best place is probably going to be the stock market. All right, but of course, it doesn't mean you invest in all kinds of stocks. You pick the ones that really suit you and your risk profile and all that, and then you invest based on that. Everyone has different tendencies, has different preferences and all that. Pick the stock that suits you. You don't like stock picking, go with an ETF. An ETF that covers the entire market or a certain sector that you're confident and bullish about, like I don't know, the tech sector, the cloud sector, I don't know. But again, you got to still do your due diligence. Not just because you buy an ETF is diversified across like 20 stocks, you don't have to do any research. You still got to do your research. But you pick something that suits you, and then you invest and hold for the long term, and then you want to come out ahead at the end when you retire.
Cool.
Yeah.
Do you feel like sometimes you spend too much time in finance and you neglect your other parts of life? Because sometimes I feel that way. So it's like, oh my god, I keep thinking. It's like,
Well, I'm probably like maxed out when it
Yeah.
comes to this. Like I'm at work with Victor and the rest of the guys. We talk about business and investing. When I get home, I don't want to think about it. Maybe Victor is different. He's like 24/7 when it comes to investing.
I also talk to my wife about it.
eat, sleep, drink, rave, investing.
Yeah, so
Yeah, I have a
Sorry,
certain
don't-
bandwidth. I'm maxed out at work. I get home, I want to play my video games.
I get it.
I want to space out.
Yeah.
And then to read some more, I mean, of course I still do, right? Because you still have to keep keep in touch with what your portfolio is and all that. But if I want to like take my mind away from it. So yeah, I think you do have to have a certain amount of passion for it, and then the amount of time and effort that you can invest in it. All right, that allows you to invest at a particular level. If you can commit more time and effort, you can probably go deeper into what you can invest. If not, then you got to invest in a simpler way that suits you. Yeah, so you don't have to be like Warren Buffett. You just pick something that really suits your character, your personality. That's the other thing. Like any other exercise program or diet program, you pick something that works for you. You don't use something else that was working for somebody else because it might not be the same for you. Yeah.
But for Victor, you can do it day in, day out.
I can do it day out, yeah.
Okay, so I just want you guys to know that Victor is an anomaly. 他是 everyday 都可以 invest one, right? So it's it's cool. I think going forward, I just want to know, like, to sum up today, right? So where do you guys see the fifth person?
I think it's pretty much just doing what we're doing. We
are you gonna launch new stuff, new programs?
Oh, you never know, because when it comes to business ideas, things could come up. So he gets a genius idea from somewhere. I don't know.
Yeah, but at this moment, there's nothing.
But I think we're pretty much just gonna do what we've been doing the last 5-6 years. We want to provide very balanced, insightful, factual information on our site, so that when people, the readers go to our site and they spend 3 to 5 to 10 minutes reading our articles, they walk away, knowing that, I learned something from that, and it's going to help me make a better financial decision for myself. I don't want to waste anyone's time when they come to our site. So we're still going to do that. We're going to still run our courses. We open them, only during 1 or 2 times a year. People come in and they really want to come in to learn a framework that allows them to direct how they want to invest, to give them a system that allows them to understand the steps required behind picking a good investment for themselves. Yeah, and we'll continue to do that. So we just want to carry on doing the good work that we do, and do it better, do it bigger. But who knows what the future can bring when it comes to business. This is such a dynamic area. Yeah, but
Things are changing too fast.
Yeah, but we don't want to lose sight of what we're doing well and what we're doing, for our readers and our subscribers and all that. Yeah.
Any last words from you?
Just stay invested.
This is like a real investor. Stay invested, guys.
Stay invested. Eat, sleep, drink, invest.
Don't time the market, just stay invested.
Hashtag Victor. Okay, thank you. Thanks for your time. I'm sure everybody learned some stuff, and we hope to check in with you guys again.
Thank you.
Thank you so much. Hey, I hope you learned something useful today and truly appreciate that you took time off to better your life with the financial coconut. Knowledge is that much more powerful and interesting when shared, debated, and discussed. I hope you would share what you've gained with people you love, and I want to hear from you. Give me some questions and help me along with building our community of financially savvy coconuts. I hope together we can fulfill our curious minds and our desire for clarity. Join our community Telegram group. Reach out to us on Facebook. Everything is in the description below. If you enjoy our podcast and feel you want to keep us growing, stay independent, do buy us a Kofi at Kofi.com. With that, have a great day ahead. Stay tuned next week, and always remember, personal finance can be chill, clear, and sustainable for all. Test. I hope you enjoyed today's episode. We kind of rushed to produce today's episode because they were going to publish their course and we got to know them in a short period of time. So we want to get their program to you guys because we feel that, hey, they have a pretty decent program, because we ourselves have tried a few different programs, and I think these guys are legit. They are better, step by step, curated, cool stuff. But also, I think they've shared a lot of interesting things, even just on today's episode. And it is interesting because some of these points I already have them. I already thought about them. But to have them share from their perspective, which they have kind of taught quite a lot of people, right? So to me, that is a more objective view, whereas mine is a lot more like anecdotal, personal viewpoint kind of thing. So for them to come on and share the objective view of the challenges involved in stock picking and what are some of the mistakes that their students made, I thought that was good. So check out thefinancialcoconut.com/value to hear more from them. And next week we're gonna talk about this one product that, oh wow, many people are talking about it in the past. I'm not too sure if it's still as popular today, but if you talk to your parents or your grandparents, the people in the boomer era or slightly after, they all have some sort of unit trust. I think most people have unit trust, and I didn't really thought that unit trust will be a thing amongst us until we did a live video and someone asked, hey, what about unit trust? How is unit trust going to perform? And then I'm like, oh, okay, then let's talk a little bit about unit trust. So next week, we're going to talk about unit trust and what are some of the ins and outs of unit trust and why I personally do not own any unit trust. So I will see you next week.